It's happening again. The headlines are screaming about a pension tax raid, people are panicking, and the phone calls have started. Everyone I've spoken to this past week has had the same question. Should I take my tax-free cash before the budget? And honestly, I get it. You've worked hard for decades, built up your pension, and made plans for that money. The thought of losing that 25% tax-free lump sum, terrifying. So in this week's video, let's talk about what's really happening, why the headlines aren't telling you the full story, and how to protect yourself before the budget hits. Hi, I'm Alefa, Chartered Financial Advisor, and I've been helping families navigate wealth confidently for over a decade. So let's be honest, it's not hard to see why everyone's on edge. Every time the budget rolls round, the same story pops up. The government's coming for your pension. And because pensions are already confusing enough, it doesn't take much for panic to spread. The media love it. Words like raid, cut, and stealth tax get clicks, they get views, but they don't help anyone make good financial decisions. And right now, the rumour doing the rounds is that the government might reduce or even scrap the 25% tax-free cash allowance, the bit that you can usually take from your pension without paying any tax. Add in pensions being dragged into inheritance tax rules from 2027 and suddenly it feels like the goalposts are moving again. No wonder people are nervous. You've worked your whole life, you've finally built up a decent pot, and now you're hearing that the government might just change the deal. The thing is, this happens before every major budget. You'd be forgiven for thinking these headlines are from the last few weeks, but they are in fact from this time last year in the run-up to the 2024 budget. Look familiar? Most of these rumours start from leaks, speculation, or opinion pieces written by people who don't actually understand how pension legislation works. But that doesn't stop it from triggering action. According to the latest data, billions were pulled out of pensions last year purely because people wanted to lock in their 25% lump sum before anything had even been announced. That's not planning, that's panic. And that's what I want to help avoid in this video, because in my experience, fear-based financial decisions are almost always the ones that people regret later. A Financial Conduct Authority response to a Freedom of Information request revealed that individuals withdrew £18.1 billion in the year to end March 2025, up from £11.25 billion the previous year. Most of that money was taken out in the second half of the year. So let's separate fact from fiction. What's actually being discussed and what's just noise? Right now, there are a few things that are possibly on the table. A cap on the 25% tax-free cash allowance, potentially around £100,000, or even a removal of this allowance altogether. Aligning pension tax relief, so higher earners get a flat rate, not 40 or 45%. And curbing or cutting tax relief available from salary sacrifice schemes. And then let's talk timing, because this is where most of the panic comes from. Every year, there's a rumour about pension changes. People assume it's going to happen immediately. Like the Chancellor waves a pen on budget day and suddenly the pension rules are written overnight. But that's not how this works. There are generally three options here. The policy is implemented immediately on the day of the budget, the 26th of November 2025, or at the start of the next tax year on the 6th of April 2026, or at some future date, possibly the start of a tax year 2 or 3 years ahead. Major pension policy changes go through a few clear stages and they take months, sometimes years to become reality. For example, when the lifetime allowance was scrapped in 2023, it wasn't fully removed until the following April, and that was a relatively straightforward change. So let us start with the rumour causing the most panic, as far as I can tell, the 25% tax-free cash allowance. At the moment, you can usually take up to a quarter of your pension pot tax-free, capped at £268,275. The rumour that this might be capped at around £100,000 or scrapped altogether for new retirees. If capped, this affects people with pension pots over £400,000. For someone with £1 million pension, a cap of £100,000 means losing tax-free status on roughly £168,000 of your savings. That is up to £33,655 of extra tax for a basic rate taxpayer, £67,310 extra for a higher rate taxpayer, and a whopping £75,724 of extra tax for an additional rate taxpayer. How much money could this policy raise? Well, Treasury briefings and think tank models suggest the cut could raise between 2 to 3 billion, depending on where the threshold is. Now, how likely is it? In my opinion, pretty slim. Cutting the 25% tax-free cash allowance would be one of the most politically explosive pension changes in decades. And here's why. People have built their retirement plans around that 25% figure. It's been part of the pension deal for as long as most of us have been saving. A clear, consistent promise that a quarter of your pot is yours tax-free. People have made huge financial decisions on the back of that. They factor that lump sum into how and when they'll pay off their mortgage, how much they'll give to kids, or whether they can afford to wind down work early. Take that away and suddenly you're not just changing a rule, you're breaking a contract of trust. Imagine being 58 with a plan to retire at 60 and use your tax-free cash to clear that last bit of mortgage. If that benefit suddenly disappeared or halved, you'd be forced to either keep working, draw taxable income earlier, or even possibly take out expensive credit to make up the shortfall. Then there's the fairness argument. People have been encouraged for years by government policy to put money into pensions precisely because they'd get that 25% back tax-free. Changing the rules after decades of contributions feels, frankly, unfair. And from a practical point of view, it's a nightmare to administer. Pension providers would need new systems, transitional protections and guidance for millions of savers. HMRC would have to rewrite pages of legislation and reprogram its systems. That's not happening overnight. So yes, it's technically possible, but politically, practically, ethically, cutting tax-free cash is a minefield. More likely could be a soft version, a cap for new savers or a future consultation with lots of exemptions. But remember, Rachel Reeves needs money now, so annoying pension savers for no real gain today seems like a stupid and improbable move. How soon could it happen? So if it was announced in the November budget, pension providers have already said they would need years to rebuild their systems to adapt to this type of new legislation. And what that means for savers is they would have plenty of time to make arrangements to protect themselves. Be that withdrawing their tax-free lump sum before any changes are implemented, or applying for the types of transitional protections that have always been offered when new pension legislation has reduced benefits or allowances. Next up, tax relief. Right now, pension contributions get tax relief at your marginal rate, 20%, 40% or 45%. The rumour is that higher rate reliefs could be replaced with a flat rate, somewhere between 20 and 30% for everyone. This one mainly targets higher earners, roughly everyone earning above £50,000 a year. A 40% taxpayer putting £1,000 in their pension currently gets £400 in tax relief. Under a 30% flat rate, this would drop to £300, a £100 difference. How much money could this raise? Interestingly, depending on where the rate is set, this policy is said to be fairly tax neutral. It simply shifts the incentive to save into pensions away from higher earners by reducing the relief they get, and increases the incentives for basic rate taxpayers to save into their pension by increasing the amount of tax relief they're given. So how likely is this one? In my opinion, pretty low. It doesn't seem to raise any money, and that is all the Chancellor's after right now. And capping relief at the basic rate of 20% has its own host of practical problems. Everyone in the higher and additional rate bands, using a scheme that deducts their pension contributions from their pay prior to tax, would have to do some form of self-assessment and pay a tax bill each year for the extra they owe to HMRC, making it a logistical nightmare. How soon could this happen? Well, much like the last policy change, this would involve system overhauls with both HMRC, pension providers and potentially all employers. It would likely be years before they could fully implement this successfully. Finally, the most recent leak to hit the headlines, salary sacrifice and employer pension tax relief, the hidden gem for many business owners and higher earners. This is where you exchange part of your salary for a pension contribution, saving both income tax and national insurance. There's talk of either capping the amount you can sacrifice or removing the national insurance advantage altogether. Now, who would this affect? Well, businesses, company directors, higher rate and additional rate taxpayers. For many, it's been one of the last remaining legitimate, efficient ways to save for retirement. Many who earn over £100,000 per year use salary sacrifice to reduce their earnings, avoiding the 60% tax trap and retain their free childcare benefits. How much could this raise? Supposedly this could raise as much as £4 billion, but making savers pay more will prove controversial given experts say workers are already not putting aside enough to cover their retirements. How soon could this happen? Well, technically, once the change is announced, the earliest implementation is likely to be April 2026. But any reforms to salary sacrifice pensions would likely come with consultation periods, so it's not a switch that will likely happen overnight. So we've talked about what's been rumoured, who it could affect, and how likely it is. Now let's look at what you can actually do. Don't act on headlines, wait for facts. If you take one thing away from this video, let it be this: don't make irreversible pension decisions based on rumours. We've seen this before ahead of the 2024 budget. Billions were pulled from pensions unnecessarily. Most of those people then lost future growth, paid extra tax, or triggered the money purchase annual allowance, which limits future contributions. So before touching your pension, it's more sensible to wait for the actual budget statement. Review your pension access options. If you're over 55 and you are already planning on taking your tax-free lump sum in the next year or two, by all means, talk to your advisor and review that timing. But don't withdraw it just to beat a change that might never come. I have come across one school of thought that says if you have a pension lump sum today, which is equal or close to the maximum tax-free lump sum allowance of £268,275, you may as well take it early, as it is unlikely this allowance will be increased anytime soon. But for those considering this, it's really important to consider that once it's out, and that could cost you growth. If it sits in cash, inflation will eat away at it. It is out of its tax shelter, and any interest will be taxable. If you reinvest it outside of a pension or any other tax wrapper, you then might have to pay capital gains tax on any growth. And for those who are more than 5 years away from retirement, there could easily be a new government in power by the time your planned withdrawal date arrives. Who knows what the rules or allowances will be then? In short, speak to an advisor who can assess your personal circumstances and needs before you make a decision that cannot be reversed. Finally, keep perspective. In these final weeks running up to the budget, there is going to be noise, a lot of it. Remember that pension changes come and go. We've had lifetime allowances, annual allowances, tapered allowances, protections, freezes, and most of it changed again within a few years. What matters is the long-term direction. Only do what makes sense for you and your family based on fact, not on rumour. So the message here isn't do nothing, it's don't do something stupid. Plan, don't panic. Stay informed and stay adaptable. If you've made it to the end of the video, thanks for watching. Please hit the subscribe button if you found this video useful. And here are 2 other videos I think you may find helpful. See you on the next one.